Trillions of dollars. That's what's at stake this week in massive options expirations. And of course, Goldman Sachs and Morgan Stanley have something to say to us as traders and investors. Short Gamma is on for the first time this year, and Morgan Stanley are claiming this lets markets move the way they want to again. Is the VIX becoming unpinned? This chart, we need to unpack it. As you can see here on the right-hand side, it's entered a new point, and it allows us to see a whole bunch of bigger moves. Both bullish and bearish are coming. Semiconductors bounced over the last 24 hours in a bit of reprieve. The skew remains quite low and soft, and the S&P 500 has seen some returns. So will we go back to the 20 moving average? And in fact, is this all part of a dead cat bounce in an overall downtrend? Well, welcome back everybody to the Daily Show where we talk about markets around the world, and the most hated sector was now the most loved again. Semiconductors putting on a super show here, led by Nvidia at 7+%, and it started off down about 1, so it was actually an 8+% move on the session. Could this have been foreshadowed? Well, we found the S&P 500 at a point where it was possible, and there was a decent little risk-reward trade that could have been taken on the NASDAQ that we'll take a look at later on in today's show. But let's talk about the Bank of America and inflows and outflows recently. First up, let's talk about large versus small versus mid caps. We'll also go into some of the unusual trades that we've seen happen over the last 24 hours and what it could mean in terms of dark pool liquidity. Large caps, we saw last week the first time of bigger flows into them. Now, that's pretty normal when markets start to sell off. We tend to see large caps come up. Small caps continue a little bit of a higher 4-week average bullishness, and mid caps seem to be the one that nobody likes at this stage. We also know that net retail buying has generally been during this fall off in retail's corner. We do also know corporates have been purchasing, but institutions and hedge funds have been net sellers over the last 4 weeks and the last week as well. So unless this changes at the end of this week, we can kind of assume that these rallies could be soft and therefore sold off. We also know that growth ETFs have led the inflows, which is the first time in a while. 4-week average has been very negative towards growth, though someone did start to purchase it last week. We have to assume that a little bit of institutions probably rotating into it. And if we look at the most positive sectors, it's all about energy, industrials, consumer staples, and healthcare over both the 4-week and current week, that is last week's average. We will update you as these come through, so make sure to subscribe if you're interested in that type of content. Let's move over to the BSPX. We've talked about this a few times. This shows us that maybe we've still got a little bit more to go. So even with these rallies, we've moved from a 70 plus to under a 70 plus, and that often has marked previous peaks. We've talked about it in several videos, so we won't go through it too much here today. But if you go back through 2023 and 22, you will notice those points. No update to smart money, dumb money yet on the confidence charts, but overall, we already know huge divergence between them, and we have started to see dumb money purchase the dip. Smart money purchase the dip, not dumb money. So overall, there has been some buying on the lows, and you'd have to say that's going towards the growth as of the last 24 hours. Average total return year to date, what's been going on? Well, it has been all about growth. Dividend stocks have become very negative, and in fact, they've been the worst of the year, and they will eventually come back through with a better return. But do think about elastic demand when it comes to dip purchasing. What's done well previously generally will do well again, then rotation will come through. So it's really about trying to pick these dips, and that's obviously a very difficult thing. How much more is there to go? Will we get mean reversion? We'll discuss that later on today's video. For investors, just always remember 17 times forward PE, between 16 and 17 times forward PE is generally a pretty good level for investment. And as we go across here, which of course we're sitting at 19 right now, and if we go across here, for the bulls out there, do remember, yes, the stats are still heavily geared in your favor for the end of the year. We expect volatility between August, September, and October. Then we expect a little bit better markets. So that's something that we'll be talking about. June OPEX was volatile. September OPEX will be more volatile than this week. And we do usually see a post-week sell-off. So do remember 723, snapshot that if you're interested from Wayne's stuff here. And that's going to be a very big point moving forward into September. Remember, we expect double dipping to occur. So even if the rally happens here, which we don't quite think it will yet, and we'll talk about that soon, then we actually will see most likely a double dip later on in September. So is it the time to have FOMO? Probably not. Bullish sentiment still a little bit high. We need these sentiment reports to come in with more bears if you're thinking it's going longer. And really, we need a 30+% bear reading. So once we get 30% plus, that's going to be a good sign that we may be finding the dip bottom. We'll be watching that this week. Volatility, does it increase at this time of year? Yes. However, it's been suppressed by 0 DTEs at this stage. So the VIX really hasn't been spiking all year. Remember that gamma stuff that we were talking about before? In some ways, what that's going to do is potentially unlock the ability for us to have volatility both bullish and bearish, which will be very interesting. This chart's a week out of date, so I'll draw it in to see what you're saying. And basically, we're at this point here. So like we reported in the weekend video, we expect markets to kind of remain range bound within maybe 100 points of each other for the S&P. And then if we're going to see the low during August, we usually would sell the week after the OPEC. So that's the week after the options expiration and the maximum pain and everything like that. As it says here, monitoring for late August bottom. That's traditionally what's happened during these times of year. And at the moment, we're following a very similar path. So let's talk about unusual dark pool and big trade options. So trade positions in general. So of course, we're testing the lows on the Qs. Q had a big purchase or sell through it last week, which we reported on. The market fell off further and it's come back to the same level. This will be a test zone for the Qs. And of course, we need to see whether sellers resume on the Tuesday. For a bear, you'd want to see it, and we'll talk about it later on. And it's something that will be important. Somebody also probably closed some of their bear stocks. So this is basically semiconductors. The morning saw a print that was quite large, and it most likely was a take profit. So somebody that's been probably purchasing bear positions against the semiconductors closed some of those. And that was a relatively large trade, so they're probably taking some profit. And why wouldn't they? I mean, it was a pretty good level to begin to take profit. We also know that somebody also purchased some decently 2x leveraged S&P 500 last week. So far, they'd be up in the money on that. We have to assume it's a purchase based on current price action analysis, but we're back into this area. And remember, until we get through this range up here, which we'll look at later on in the indices discussion, we can't really be sure that this dip is over and that we're buying the rip again. That's going to be the biggest problem that we've got. And of course, gold, one of the sectors that's not been faring so well, did get a monster dark pool trade on it over the last 24 hours. Now, this is gold shares, GLD. We're also seeing, of course, some of the gold shares such as GDX and Barrick doing a little bit better than the shiny metal, which has suffered in recent trade action. Let's move over now to the most unusual of the trades or the single stocks, and that's got to be J&J. I don't know what's going on with Johnson & Johnson, but I can tell you the amount of trades coming in here are massive and everywhere. Is it some giant sell or buy? We don't know yet, but we will be looking for a weekly closer out, above or below, and J&J becoming one of the more interesting stocks in the current market conditions. Do remember, we're still in earnings reports, and although 85% of them have reported, we've gone through, or maybe even more now, we've gone through the biggest ones. We still do have some interesting ones coming forward. I think SEA is a standout, Target, Cisco, Walmart this week. These are going to be the volatile ones. If you like to play options, make sure you get your expected moves and have them all available. And do also remember to follow us over at FX Evolution on our Twitter. We're posting a whole bunch of these charts and graphs and everything else, so we will be very active there. So remember to follow in the links down below. Unusual options activity. Well, J&J continues to present here with a 6.64 times average 90-day volume. Wow. Equal amount of calls and equal amount of puts. It's very difficult to figure out which exact direction. We also saw Exxon placing a monster amount of calls in comparison to puts, 5.88 times the average volume. These are huge positions. AMC also trading monsters. You can see here puts were just out of control on this, and there was a lot of options activity throughout the session, but in all sorts of things that most of us usually are not in, and that's going to be an interesting point. Disney also just slightly above the average. We've started to like that stock as a maybe short-term buy signal from a TA perspective, and we'll look at that a little bit later on. And of course, 54% calls, 46% puts, showing us that even though the options volume overall was below, we still have the calls and we still have some really large trades coming through from some of the individual stocks. Semiconductors put in the best session. They started down, as we mentioned over here, rallied the whole rest of the session. We also saw weird rallies when we had metals rallying. of some type of China news, which we'll look at in future videos. We've got some amazing data coming out from China that we want to talk about in terms of seasonality. I think you'll be very interested in that, so make sure to subscribe. And then, of course, we had utilities and gold doing pretty badly. Most of the defensives, energy, all of those things were down on the session. It was mostly risk on over the last 24 hours. The sectors that have been beaten down the most got a strength boost. Now, if we take 5 days, we know that energy, healthcare, biotech, metals, utilities, all these defensives have been the best, and semis still remain down over 5 days, down 3.37. So it's not time to freak out just yet and say, oh, everything's back, it's all great. Well, that was a very, very large move on things like semiconductors. So it does make me think that whatever this rally is could be still beaten down by a bear a little bit later on, especially with what we've known from Morgan Stanley and Goldman Sachs reports. Let's take a look at what usually happens when we get a significant turning of the markets. Here's a great one, which is percentage of stocks above 20-day moving average. That's moving back down. It's sitting at 34.52. We're looking for that to get underneath 25. We will report if that's happened. Not quite yet. So again, if this rally continues, maybe we won't get it, but on average we do. And I still think this chart is pointing towards some kind of riskiness coming up. We're almost in the new unknown. So that means that if we get past 5.1% on yields, where do we go? We go into a new unknown area. Markets hate the unknown. So wherever this is going, it could be Bank of Japan, it could be all sorts of reasons, we are increasing yields. And if that goes through 5.1, as we've said, that's usually negative towards markets. And we have our alerts ready on both sides. We're straddling that so much. We're also watching the the JP10Y, which if that continues to spike up 0.7, 0.8, it'll probably be a problem for US yields as well. Remember, treasuries are everywhere at the moment. We've got huge amounts of issuance of bonds and everything else, yet this yield stuff is still becoming a very strange conundrum and something we need to look at. In terms of defensive versus staples, no new break to the low, so we don't know that it's all defensives yet. And it's basically just holding its own. So this is XLY versus XLP. It shows us 1/3 of the US economy, which is effectively consumerism and in general spending. Let's move over to semiconductors. Big rally. Let's have a look down in the hood. We fill the gap. Nothing unusual there. We're coming back to this area. We could even go as high as this zone here. And what we could do here is we could pull a fib from the high to the low. And it's very feasible to see this market go up into these 154s and stuff like that before turning back around again. So it's like that. The faster this goes, if it smashes straight into that, very likely there's a seller that's going to be entering around 154. That will fill a gap. It's already filled this gap, but anywhere in here realistically marks where sellers could recommence. And of course, we've got this candle as well at 152.40 plus previous support becoming resistance. So it's not unexpected that this would occur. Semiconductors are starting to face where the bears should sit, and buyers, of course, would be happy with themselves over the last 24 hours, buying in this little level of demand. If we're going to get a proper sell-off, which I'd like, and this is usually what happens with proper sell-offs anyway, we should move down to 136. I don't know that's going to happen, of course, 132, 136, but it makes sense across so many single stocks that we'll look at later on in today's video, and also the indices as well. It would be a really healthy, good correction in what's been a pretty outlandish rally since March. If we go to copper, no new low, mark out the low, make sure you've got that on your chart set. That's going to be around 3.68. That's going to mark potentially a big turning event in the markets themselves. And of course, we go to global liquidity and central bank liquidity in general. Still incredibly disconnected from this market, which is unusual. You've usually tracked it and mean reverted back and all sorts of things. We're still a little bit too far away from that. Let's move over to US oil now. Everyone's discussing it. We know that we broke to a new high on the daily, on the weekly. We got a doji and we came back down to the trend line, which has been pretty stable. I mean, you could say this is a fairly decent trend line through the back of oil. It has been making a series of higher peaks and higher troughs, which points towards this still being a buy zone for oil for now. And of course, if it gets past that level, that will be fantastic. We probably look towards new highs and maybe even that 90 to 92 a barrel. Now, we quizzed our community, you guys out there, and we asked whether we thought 90, 92, 100 plus, or pretty much where it is right now is the top for oil. And you were almost all split down the middle. So it was almost like 25% for each one. and everybody didn't have a clue, which is usually means it's a very interesting market. But the trend is still bullish until proven otherwise. So higher peaks, higher troughs, that's what it is. It's a trend up at this stage, although it is still at a critical point. Dollar index just boosted and it ran straight into our weekly take profit. And yeah, well, it hit it. So it did take the highs here. It's obviously filled in probably a little bit of gaps that were over there, and then it's seen some selling. Let's have a look at the smaller time frames for the US dollar, which, you know, at the moment is really just boosting thanks to yields and a whole bunch of other stuff to do with, you know, the macro of the world. But we have a high, we have a low, we have a higher high at the moment. Do we have a change of trend? No. Is this an important level? You could argue on the small times it's going to be price-wise, so everyone knows 102.62 would be around that low level. And we're looking to see whether the market will take that and then form a topping base. At this stage, though, trend is still up, even though it's hit into our target, which I think is actually a very good target. I don't know whether it's going to stop just yet. We don't know that yet. Let's move over to gold. Now, this metal continues to disappoint through this area, but we knew it may do so. And you can see it's back on that demand zone from previous. Watch this. Do not necessarily just buy gold randomly here. We haven't been able to see any turns in gold yet, so the trend is still theoretically down. We're on this demand zone that we found buyers before. But as I mentioned several times, you know, if I was to choose gold right now, I still think that the gold stocks present better value, such as Barrick, etc. And they have much better turn points. So if you look at Barrick, it's got that really nice big bullish hammer that came off the bottom. You've got the change of trend. You've got the base accumulation, decent trade volume through it. All of those types of things that make it look better. It was down the session 1.42, but down less than GDX and less in general than gold itself overall. So that's important. Tesla traders. Oh, I don't even know what to make of this. This is an interesting one because we opened underneath and then rallied right back. We did end up down 1.19, but it's not like we closed under 240 with a bearish red candle. And that does matter because it basically means that we defended this zone back up to where we thought the buyers would recommence. Yeah, tough. If you're selling Tesla, I don't think you've got to be scared yet. You would want to mark out around that 251 mark though, because if that gets broken above, most likely we are in a nice purchase to 270 on Tesla, which I think is a good area. But yeah, big rally here coming through. Let's see if we can garner anything from a small time frame such as the 15-minute. And I don't think we can, not really. Maybe a 15-minute trader or 1 hour trader could mark out 243 as well. And if it does open with a gap, because we have a gap down now, then we get a gap up. If we then breach 243, you've got to think we're going towards 250. So trend still down on Tesla for now, but yeah, not exactly the trigger that goes 210 or 200 because it did close bullish and green. It did actually make up, and even though it was underneath 240, that's exactly where we expected the buyers and the sellers to fight. So yeah, very tough to read that chart at this stage. Let's go over to Apple. It's still holding the 20 moving average. I don't have it on the chart here, but I can tell you it's on mean reversion. It's on the demand. I still think Apple, like other stocks, should come back down here, back into this range of 160. It would make the most amount of sense, but we're seeing a little bit of rallying after what's been basically some aggressive selling. That's fair enough, and it's coming across pretty much all the sectors at this stage. Whether I load up something like a Microsoft, and we have a look at that, again, 20 moving average, you can see again there's some gaps that have been left behind during that previous rally. It'd be nice to see some of those get filled if we were to come down further. And I think if you pull like a fib from the bottom all the way up, you'll notice that these mark out some important areas such as golden fibs as we're moving. Let's talk NVIDIA now. So NVIDIA came down dangerously close to 400. It pretty much tapped it, I think, in the pre-market, and then it just rallied. And this is elastic demand. So NVIDIA put in what I would mark as a pretty important point. Negative 15% top to bottom over a relatively quick time. Not as fast as I'd like it to sell generally, but relatively quick time. We know that this stock remains the buy the dip strategy. And it's kind of like AVGO in many ways, Broadcom. Once it drops that much percentage, you expect incredible gains. The question is, can we really see this as being the right investment by the dip with so many gaps left behind? I wouldn't be surprised at all if NVIDIA posts another bullish couple of sessions, maybe push it up into here. But I do think that NVIDIA is more than likely going to struggle for overperformance moving forward over the next couple of months. and more than likely it will fall back to this level or lower. And that's based on semiconductors, that's based on the massive demand spike here. And just because it's huge doesn't mean that this is filled with tons and tons and tons of trade. So if we have a look at the volume here on the charts, you'll see, yes, it is a big volume day, but it's not actually that much bigger than any of these previous ones. And what that's telling us is that it's huge trade with relatively thin considering the move. I mean, 3 days down here, we got way more sell trade than we did end up in the buys. I do think it's probably retail. I think it could be trappy. We're going to watch it. It's one of the best stocks in the market, if not the best stock at the moment. So it's one that we have to watch and we have to remain vigilant on. Disney, probably one of the worst stocks of the big ones at the moment on the market, did come back and it hit into our green box and it found a little bit of buying, ended up down 0.24. This is more of a defensive play. We saw a switch of trend. We're looking at this being defended at this stage, at least temporarily, maybe back to $92 or even $94. So Disney at the lows here, looking the best it's looked for quite some time. Let's move to indices now, and we'll start off with CQQQ. So no trades here. We will update our thoughts on China and moving forward. But what I have always said is I still don't think anything really happens till October. And September, October tend to be where you see this uptick in anticipation of the big announcements that the central government generally makes there. Now, do remember, this is almost a predictive kind of way of looking at it because it tends to happen before. Do we have solid technicals? Well, yes, we do. Do we have the potential of an island reversal? I guess we do as well. Is this economy sick? Yes, it really is. It's really bad, yeah, unfortunately. But the technicals are the technicals, so we're looking for the catalysts, and we'll continue to watch that like we've been saying. XJO continues to play the double top for the Australian market out there. You can see it came back and retested this. It made a new low. It's come back. Like to see further selling here if that was to play out. It will follow, in general, the US market, but at this stage, the trend is actually down on the small timeframes for the ASX traders. The German market is absolutely not knowing what it wants to do. We made bear and bull cases for this in the live stream. We made a bull case for exactly where it was and a bear case for where it is right now. So basically, this is where selling is going to commence. They need to sell it. If the German market wants to sell, it's going to sell its own. It already tried once during the session, and then it rallied back up. That's definitely a question mark. I'd like to see it continue to sell, not make a new high above here, and for this to basically keep playing out the Wyckoff that we've been discussing in previous videos. US 2000 played catch up to get low enough so it could bounce. It came back close to the most traded zone. Resistance, support. We knew that around here would be where buyers commenced, and they tried. They pushed it back up, and it was okay on the session. It ended up pretty much flat, but it was down. Let me have a look at that overall. Percentage was down 1.27 and then it rallied back up to the highs. But the more interesting market has to be the NASDAQ and the S&P. This was the trade we were talking about. And we basically mentioned it right here with a decent risk-reward strategy. Low stop loss, nice little buy in here if you wish to take it. And then, of course, I would have rallied it probably into around this zone in here. Maybe not as high as it has gone. And the reason why is just because it's more possible that happens. About a 2-to-1 to 3-to-1 style trade. Good little one, pretty replicable. If you're interested in those types of trades, then you can check out our day trading masterclass down below in the link description. It's certainly a day trading masterclass special. Let's move over here to where we are right now. So we've retraced from this previous low back up. We've also found this little trend line. Not that I like using trend lines, but we are kind of in that area. And we continue to make, remember, in general, lower lows and lower highs. Now, something's changed down here, and we have seen some large trades on the Qs, etc. recently. But yeah, if markets are going to really find the bulls, it needs to snap all of these supplies. We know this red box up here is key. We know this green box is also key. This is also a little bit of a zone. But as I usually like to do, let's look at the S&P 500. Bull case scenarios. Trend line, which is weak. Daily 50 moving average, not bad. Outside of Bollinger, generally we return back to the 20 moving average at that point. Very common style of strategy. So is it this, the bounce of all bounces? Is this the biggest sell that we get and we just keep rallying back up? Well, history would say probably not, based on the fact that August end tends to be the bottom. Remember, this does tend to be the sideways week. So what if we did this and we did that? Okay, makes sense. 440, 435, and in a perfect case, about 4,150 to 4,200. That would be perfect. That would be really, really nice. Take off a lot of this rally, push back down to the level, bring back, that really heavy trade zone. I'd like that a lot. I think that'd be pretty sweet. I'm sure some of you would dislike it, but yeah, that would be the thing that would probably make it a more healthy market. Let's look at this on the futures now. Again, these levels are all potential buy demands, and down here at the most traded level. So these are all areas, and this 20 moving average, and where I've kind of put a box, is where I think the sellers would recommence if they were getting very excited about selling the market. Let's have a look here at why. Well, the reason is look at the sells in the past. We know there's supplies. We know there's sellers there. Yes, I understand there's a gap up here as well, guys, that you want filled. But yeah, look, change of trend has happened on very small time frames, 15-minute, 2-hour, 1 hour and under. But the remainder, the things like the daily switches and stuff, have still remained bearish at this stage. So I could see the market rallying up here and then maybe selling. If you're going to sell it right here, right now, you're probably looking at that market to retrace back to the 61.8 fib, which it has done at this stage. And that's been a relatively consistent little sell method throughout most of this dump. So still a new low. It's rallying up. We expect this type of thing. But let's take a look at the options market now and look at maximum pain. So we'll load up max pain and let's have a look at what's going on there. Let's go to the 18th. Which is this expiration. And then we'll have a look. It should be about probably about 2 to 3 million units. Yep, 3 million units open. And the biggest options expiration levels are 440 puts, 430 puts, and of course 450 calls. So we expect 450 to remain the call wall this week. We expect the put walls to remain 440 and 430. And basically the market should stay within that 200-point range. Now, that's maybe not much of a prediction, but you can see that when we come up here, we're facing resistance. When we come down here, we're facing buying pressure. And when we come down here, we're facing pretty much equilibrium. Maximum pain sits at this week currently 438. So that actually dropped off from 440 over the last couple of days, in fact, the weekend. And what that tells us is that there were more calls entered. So at this stage, it looks like calls are entering, puts are still weakened off a little bit, and yeah, it's a good dynamic for this week's options expiration. So 440 would be right around where you would expect the market to get to by Friday close. We'll find out whether that does occur. Bitcoin, it's so boring. I mean, I like Bitcoin and I'm certainly a fan of it moving forward. That's probably my favorite coin, that and Ethereum. But, realistically, this is just coiling up and down, and it's not doing anything. It hasn't broken 30,400. It's still downward trend at this stage because we're moving towards 28, 27 and a half. And that's where we're at for the crypto. So yeah, that's what's going on right now. Let's move through what's happening. We do have some CPI for the CAD. We've got core retail sales, 8:30 a.m. I expect this to be worse than that number, but we'll find out. Core retail sales, 0.4%. What do you think in the comments down below? Is it going to be 0.4? Is it going to be 0.2? Is it going to be weaker or stronger? I don't know. I think they're optimistic on that one, really. Let's move down here. Official cash rate, RB New Zealand policy. Cash rate 5.5. Remember, my opinion means nothing in that, by the way. That's just a complete guess. FOMC meeting minutes, 2 p.m. New York time, Wednesday, August the 16th. And then we go through and we see that we have unemployment claims here at 8:30 a.m. So there's still a little bit of news coming out, and that will be a catalyst for markets. But in general, we are looking at the options expiration, and we're, of course, looking at the dynamics of this potential dead cat bounce into the rally areas where the bears sit. They're still in control. It's the right time of year for bears to commit to this market. And, of course, we're seeing a little bit of that deleveraging as well. So that brings us back to the question here in terms of net gamma. And it basically means that when we talk about this, there's some evidence that Wall Street dealers with the capacity to move millions of shares to hedge their books have shifted to a posture where their selling has potential to exacerbate market swings. So remember, the thing with vol at the moment is that we've seen none. The VIX is basically negligible. It's doing nothing. We haven't seen that much volatility in terms of 1-2% moves in the S&P 500 for quite some time. This opens up what we saw in 2022 again. As you can see here, very volatile year. If we look at 2020 during certain times, very volatile year. During 2020, more volatility. Then it became less volatile through 21 into 22. So yeah, we're opening back up. We've got this vol. This is going to be exciting. Make sure to subscribe and check out more soon. Bye for now.